Welcome back. Today we learn about the tax returns, taxable source and allowance gates. In this course, we'd like to talk about how to know and to have a full comprehensive guide to identifying taxable income streams, calculating baseline liabilities, and maximize allowance. Let's do this. What are taxable sources? See on the image. On the image, we have three things. First, the payroll, investment, and corporate housing. Taxable sources represent any incoming cash flow or economic benefit that tax authorities legally track and subject to personal income tax. So, every money you gain, you must pay a tax. First, for the earning income, for the investment income, if you have a gain in your investment, you must pay income. And for your passive and side income, you must pay an income, a, a tax. What is the key tax formations? Let's take a definition and the formulas. The gross income, earning income plus investment income plus side income. The raw total of all generated cash inflow. Adjusted gross income. The gross income minus above the line deduction. Corpus line used for tax eligibility limits. Taxable income. Adjust gross income minus standard by itemized deduction. The final amount subjected to the tax bracket. And the last, the effective tax rate. Total tax owed divided by gross income multiplied by 100. The actual percentage of total income paid. When and why track taxable sources? Tracking taxable sources dynamically allow individuals to accurately forecast liabilities. This transformation of financial tracking created actionable insight into a taxpayer's capability to leverage structural tax shelter before deadlines. If you monitor stream consistently over the fiscal years to avoid under withholding and unexpected tax bill that help you to pay your tax every month, every year. Let's take a theoretical example, calculating a baseline tax. Let's apply the structure framework to a hypothetical profile, alpha taxpayer, with fiscal years 2025 metrics. With his gross activity salary, he gained 60,000. Dividend distribution, he gained 5,000. Independent consulting fees, he gained 15,000. Standard personal allowance, he gained 14,000. The total net taxable base is 66,000. Why we had 66 total net taxable base? Because the gross income is about 18,000. The allowance cut is 14 allowance cuts. So the taxable base is 66,000 net. Effective basis reduced raw liability by 17.5%. Visualizing the theoretical saving. Interpreting this result. The taxpayer shelled 14,000 from taxation via allowance at the marginal tier. This retention saved 3,000 in absolute cash. The remaining 66,000 is distributed across progressive bracket, maximize capital efficiency. A maximum allowance utilization keeps absolute effective tax exposure stable even when gross earnings increase. Let's take a real-life example. For a freelance consulting, consider a consultant with annual gross revenue of 100,000. Equipment, software, and home office costs totally 20,000. Qualified personnel and retirement allowance total 15,000. Net taxable baseline equals 65,000. Despite healthy top-line earning, operating structure and personal allowance protect final liquid cash, a classic dynamic for a micro business. The gross margin is about 80% and the taxable base is 65%. Comparing allowance context matter. Why categories vary? Adjudication same change radically between salary employees and independent workers. Always categorize eligible items based on statutory definition and clear documentary proof. Salary workers rely on structural standard personal allowance. Freelance maximizing direct business expense itemization, investor optimization via tax advantage, account and losses. What is your expert tips? How to maximize the value of your annual tax allowance? To maximize this, track years-round trends. Log deductible receipt dynamically to secure clear audit, trial, and spot pattern change early. Combine account type, cross-reference retirement account, healthy saving, and professional deduction for compound optimizations. Benchmark against standards. Statutory average provide critical context. Drastic deviation highlight compliance risk or misses optimization. Drill into line item. When policy shift, investigate underlying text definition to adjust investment choice to current laws. Let's take a takeaway. Now your source. Comprehensive stream mapping reveals exactly what income get exposed to marginal tiers. Master the code. Standard and itemized option it's tell a different part of optimization story. Track deduction continuously. Proactive allocation. Capture major cash flow exception that retrospective feeling completely missed. Apply compliance rule. Combine documentation, cross-check rules, and investigated structure driver behind your calculations. Tax allowances are not arbitrary rules. They are the legal blueprint of personal financial efficiency. Learn to read them fluently. So, if we resume, before you pay a tax, make first a calculation about your tax allowance. If you know your tax allowance, you could place your money in a good trend to deny over taxes and don't to pay much more taxes. That is for today, guys. Thank you very much, and I hope to see you tomorrow for the next video. Don't hesitate to subscribe in your channel to help me to create a new content. Thank you very much.